Welcome back, guys. Thanks for clicking on my video. If you missed part one, I recommend you check out that video because it's got some other big name stocks in it that you might decide are a good addition to your own portfolio. With that being said, I'm going to be ranking these the same way I did in part one, with the number one factor being valuation. Now that that's out of the way, let's hop into it. First stock today is Google. Now, something you guys will get to learn about me is I'm not the one that searches for the next, quote, moonshot, if you will. I'm looking for the modern day equivalent of a toll bridge. I want a business that is deeply integrated into the lives of billions, possesses an unassailable moat, and generates so much free cash flow that it essentially runs out of things to do with the money other than give it back to me, the shareholder. Google is exactly that business, and as we head towards 2026, the market is giving us an opportunity to buy this compounding machine at a fair price. My main thesis rests on the realization that the AI death of search narrative was a massive miscalculation. While critics spent 2024 and 2025 worrying that ChatGPT would kill Google, Alphabet was busy integrating Gemini into its entire ecosystem. Today, Google search is not just a list of links, it's a sophisticated answer engine that has actually increased user engagement. Because Google owns the intent data of the world, advertisers have nowhere else to go that offers the same return on investment. This is a monopoly that is evolving, not dying, and does it at scale with its AI infrastructure. That cost per queries is dropping, which will lead to significant margin expansion by 2026. Beyond search, we have YouTube, which I believe is one of, if not the best, business models ever created. It is now the dominant streaming platform on the planet, consistently beating even Netflix in total watch time on actual television screens. With a rapidly growing subscription base and a toll taken on every creator's success, YouTube provides a high margin, recurring revenue stream that is largely decoupled from the traditional ad cycle. When you add in Google Cloud, which has finally crossed the threshold to massive profitability, you have a three-headed monster of cash generation. Alphabet is no longer just a search company, it is a diversified infrastructure utility for the digital age. Lastly is Google's wildcard or speculative endeavor, Waymo. Waymo has touted off in the early days as a waste of capex and something that was a terrible idea. For example, Bill George, a Harvard professor, and various analysts argue that Google was drifting away from its core search business. The prevailing sentiment was that Google was spending massive amounts of shareholder money on, quote, moonshots that had no clear path to revenue. However, in their defense, Google announced Waymo as Project Chauffeur in 2010, which then sounded like a science fiction rather than a profitable business model. Then in 2020, Waymo had their commercial launch in Phoenix. For the first time, anyone with the Waymo app could hail a car and be picked up by a vehicle with an empty driver's seat. Then, 3 years later, Waymo received final approval from California regulators to operate 24/7, fully driverless commercial services across San Francisco, marking their first major expansion of the 100% autonomous fleet outside of Arizona. Come quarter four of 2025, and Waymo is doing roughly 450,000 rides per week. Just 1 week before that, this number was around 100,000. I purchased my Google for around $165, so I bought at one of the better times in recent years. However, it's now almost 100% higher at $320 per share. If it weren't for the recent run up, I would put this in S tier, but due to that, it's still going in the A tier. Next on our list today is Amazon. For years, Amazon was seen primarily as an e commerce giant that happened to have a cloud business on the side. But as we head into 2026, the narrative has completely changed. The company is currently in the middle of a massive efficiency era, pivoting from post pandemic expansion to a leaner, AI centric giant under CEO Andy Jassy. Wall Street analysts are increasingly bullish, with many projecting a major breakout in 2026 as the company's massive $125 billion investment in infrastructure finally begins to pay off in the form of accelerated revenue and expanded margins. The real engine behind this growth is Amazon Web Services. which is entering a new acceleration phase. After a brief slump, AWS growth is reaccelerating towards the high 20% range as the market shifts from merely training AI models to inference, the stage where AI is actually put to work in real world applications by developing its own custom silicon like the Trainium and Inferentia chips. Amazon is offering a 40% price performance advantage over traditional hardware, essentially building a silicon fortress that makes its cloud ecosystem incredibly sticky for enterprise customers. Beyond the cloud, Amazon has quietly built one of the most profitable advertising businesses in the world. Annualized ad revenue has already cleared $60 billion, outpacing the growth of its retail and subscription segments. This segment is expected to surpass $85 billion in 2026, driven by high margin placements on Prime Video and sophisticated AI driven targeting that connects directly with shopper intent. Even the core retail business, which faced pressure from new competitors, has become more efficient. Thanks to logistics regionalization, North American retail margins hit a record 12% in late 2025. Looking further ahead, 2026 marks the launch of Amazon Leo, formerly Project Kuiper, the company's satellite internet service. This project is set to open a massive new recurring revenue stream by providing high speed connectivity to underserved regions and government contracts. With a forward price to earnings ratio of roughly 30x, many experts view the stock as an attractive buy for 2026, seeing it as the ultimate pick and shovel play for the AI driven economy. In short, Amazon has spent the last 2 years building the foundation, and 2026 looks like the year it starts building the skyscraper. My number one catalyst for Amazon being the largest position in my own portfolio is humanoids. In late 2025, leaked internal documents and reporting by the New York Times revealed that Amazon has an ambitious long term roadmap to automate a massive portion of its workforce. According to the leaked documents and recent reporting, Amazon's final goal by 2033 is to have 600,000 fully functional humanoids and to automate 75% of all operations. This would save them roughly 30 cents per item process. That includes picking, packing, and shipping. If Amazon has 1.5 to 1.6 million employees today, 600,000 robots would mean they have to pay around 35% less humans. Their estimated people cost, if you will, is north of $150 billion per year. If you cut that down by 35%, that's over $50 billion they're saving every year from not having to pay those workers. I think it's pretty obvious where Amazon's going. This is an S tier stock, and I could not be more bullish on it for not only 2026, but the coming years. Next, we got Tesla. And I'm not going to go as in depth with it as I did with Amazon and Google with Tesla, because everyone is pretty familiar with it, I'm sure. But, anyways, Tesla is currently at a critical crossroads, transitioning from a high growth electric vehicle manufacturer to an AI and robotics company. For the past 2 years, Tesla has faced a growth gap where automotive margins have been squeezed by global competition, especially from Chinese manufacturers like BYD and interest rate pressures. Also, revenue and free cash flow growth have stalled for the past 3+ years compared to the explosive 2020 to 2022 era, making the stock's PE ratio unattractive to a value investor like myself. The bull case, however, and the reason for its extremely high valuation, which I believe is almost 100% based on speculation, is almost entirely dependent on autonomy and robotics. The bulls, Tesla is not a car company, it is a distributed compute network. The thesis relies on unsupervised, full self driving in the cyber cab, turning Tesla into a software as a service business. My issue with Tesla's full self driving robotaxi vision is that Elon loves hyping things up and giving us a date, then missing the date and delaying whatever said release was, and sometimes even delaying product releases multiple times and for multiple years. Then, when he feels like investors are about to jump off the Elon and Tesla hype train, he brings up some new flashy vision to keep the speculation going. His latest effort with this has been Optimus and mass producing humanoids. And let's not forget to mention Google's Waymo, by the way, already performing 450,000 weekly rides, as I mentioned. Tesla doesn't even have full self-driving rolled out to the public yet. For these reasons, Tesla's either a low B or high C tier stock. You could put it in either one and I'd be okay with it. But due to its decelerating growth and valuation purely based on speculation, this is a C tier stock for me. Next, we got Netflix. Now, I love everything about Netflix today, trading around $90 a share. The revenue is in a strong uptrend with average yearly growth around 15%. Same with total subscriber count growing around 15%, and their free cash flow is exploding at 25% year over year growth. So if there was nothing going on with this company, this would be an S tier stock in my book. I also have a decent sized stake in the company with my own money relative to my portfolio size, obviously. However, due to the current environment in their world, I can't rank it as an S tier. As a long term investment, though, this is absolutely an S tier for me. But since the video is for 2026, this is a B tier investment for me. Now, let me explain this. During their last earnings report in October, they announced they have to pay a one time tax bill in Brazil of roughly $620 million, which made their earnings per share take a big hit. So that sent the stock down around 10% in one day. However, that's not the main reason for my B tier rating. In fact, I think that is nothing but a tailwind and will not affect the business long term. I believe the situation between Netflix and Paramount, both trying to outbid each other for the purchase of Warner Bros., is going to cause the stock to perform flat to slightly down due to uncertainty from investors. Stocks do not like uncertainty, and I believe this sentiment isn't going anywhere until the deal is finalized, whether Netflix wins the Warner Bros. Bid or loses it to Paramount. I think Netflix is going to be an example of a business itself outperforming the stock and will lead to a fantastic buy opportunity sometime in the next 6 to 18 months or however long it takes for this deal to happen. However, like I stated, since we're only focused on 2026, this is going in the B tier for me. Next on our list is Uber. And if you watched the last video I made, which is the same concept as this one, just different stocks obviously, I started the video by stating I love listening and following those who are smarter than me, and I gave some names as examples. One of those names included Bill Ackman. If you're unfamiliar with him, he's in charge of managing over $18 billion and has around 20% of his portfolio in Uber. So clearly there's something he finds very, very attractive with this company. While doing my research, I found that in 2022, when Uber was trading around $20 per share, it had a PE ratio that was well into the red, along with a negative free cash flow yield. Keep in mind, the higher the free cash flow yield is, the cheaper the stock is to own. Now that the stock is $80 to $85 per share, this yield has only gone up with stock price now, hovering around 5%. This is a textbook example of a strong, growing company. Bill Ackman himself even said recently in an X post that it is still undervalued today, even with the strong performance in recent years. Price to earnings has also decreased alongside free cash flow trending down as price increased. In case you needed more reason why this is such a good investment, the free cash flow was a negative $5 billion in 2020 and reached profitability in 2022 at $672 million in free cash flow. Today, that number now is just under $9 billion. Also, their gross bookings are growing extremely fast at 16% year over year. This includes transportation, Uber Eats, freight, etc. Something that I didn't even know before throwing money into Uber, since I'm not a user of the business myself, is that they have also built a $1 billion ads business, showing ads to a captive audience waiting for their car or tracking their food, which is an incredibly high margin revenue stream that drops straight to the bottom line, significantly boosting free cash flow. What I mean by captive audience is that when an individual is waiting for their driver to pick them up or their food to be delivered, they are constantly checking their phone with the intent of not making their driver late or meeting their food delivery at the door, if you will. When you are showing ads to an individual, or in Uber's case, a large group of individuals who are glued to their phones for this short period of time, this turns into extreme profitability. In my book, Uber checks all my boxes as an S tier investment for not only 2026, but also the long term. Next, we got Robinhood. I sort of have a sweet spot for this one personally, as it might be the best trade I've ever made. I bought it around like 13 or $20, somewhere in there, back in 2023 and 2024, and sold around $100 per share. In hindsight, obviously, if I would have held, I would have more than 10x my money, but I didn't want to get too greedy and round trip all my gains. I'm one of the people who I've done that one too many times and I've learned my lesson. But anyways, back to the topic at hand, which is that Robinhood has successfully moved past the meme stock chaos of 2021, but it is still fighting to prove it can be a serious all-in-one financial hub for the long term. They've done a fantastic job shifting from transactional revenue, which is purely relying on people trading, to subscription revenue. Robinhood Gold subscribers are growing and creating a predictable, recurring cash flow that the market clearly loves. They also offer a 3% match on IRA contributions and high yield APY for Gold subscribers. They are successfully graduating their young user base from $500 gambling accounts to six-figure retirement portfolios. They are capturing the greatest wealth transfer in history as Gen Z and millennials inherit their money and are moving towards newer brokerages/banks rather than the traditional ones like a Wells Fargo, for example. My biggest issue with Robinhood, though, lies in the fact that their health as a business is still tied to retail excitement. When the market is flat or boring, trading volume dips and the stock tends to bleed. They haven't yet proven they can thrive in a sustained bear market where retail interest vanishes. I believe Robinhood has a bright future ahead of them, assuming no unforeseen circumstances come about, since they are clearly working towards being an all in one financial hub. Since this is sort of a Tesla type stock where its valuation is a little bit propped up by speculation, I'm going to be putting Robinhood in the B tier today. Next on the list is Ethereum. Something you'll learn about me is I'm a huge fan of cryptocurrencies, specifically Bitcoin and Ethereum, mainly for the fact that they have the potential and ability to reshape our entire financial system as we know it. Now, there's a few reasons why I give Ethereum an S tier for 2026. One of the biggest reasons is the same as Bitcoin, if you watched my last video, where I went over my thoughts on how it will do in 2026, that being institutional adoption and investments. With interest rates falling in the US, institutional investors are hunting for a yield. Ethereum staking yield is typically 3 to 4%, which becomes incredibly attractive compared to treasury bonds when the Fed is cutting rates. This creates a floor for the price the other crypto assets simply don't have. And this is not a hypothetical, it is already happening. Ethereum's staking entry queue is now larger than the exit queue after nearly 6 months. Right now, there's around 1.3 million Ethereum lined up to enter staking with an average wait time of 23 days, while there's only about 3,000 Ethereum waiting to exit with a waiting time of just an hour. Not to mention, we are also within months of BlackRock's Ethereum staking ETF being approved. Now, the next bullish catalyst I see is that the daily transactions on the Ethereum network are now at all-time highs, surpassing 1.8 million transactions per day. This is incredibly bullish for Ethereum for the reason that Ethereum's economic model is built so that a portion of every transaction fee is burned or permanently removed from circulation. This means Ethereum is deflationary. When transactions hit all-time highs, the network burns ETH faster than the amount of ETH that is created via staking rewards. This causes a supply shock. Now, my last reason has to do with the geopolitical environment and the United States government. With the current debt problem in America, the government has three ways to go about, quote, tackling it, if you want to call it that. Number one is to default on the debt, which they aren't doing. Two is to cut spending, increase GDP, which isn't happening. And three, just inflate away. The last option is pretty clearly our government's preferred choice of action, as we've seen with the devaluation of the dollar. With that being said, though, I'm going to go into a little bit more depth in this video. This blue line is the Federal Reserve's balance sheet, and then this other one is the price of Ethereum. And since Ethereum doesn't have the typical business metrics, the revenue, the free cash flow, earnings per share, all that good stuff, it's almost entirely liquidity driven. So if you look at it, when the liquidity dries up, it goes down, the price tanks, and then it kicks back off. And what happens? Ethereum goes on a crazy rally, and then they turn it off again. Here we are. So, usually what happens when the Fed prints money is obviously inflation. But with the recent events in Venezuela, since we seized hundreds of billions of barrels actually of oil, the Fed is free to print money with little to almost no inflation. And since we got the oil, I think we can clearly see, if I get rid of Ethereum, you can clearly see this has started ticking back up. And as we saw with Ethereum, when this starts kicking back up, risk assets or like small cap stocks or crypto, Bitcoin, Ethereum, they love when the printer's going. Last on our list today, we got the metals, or precious metals, I guess, but specifically gold and silver. But it kind of goes for all of them. I think they're all going to perform relatively similar in 2026. So, anyways, these metals currently function as a hedge of last resort rather than a primary engine of wealth. While the debasement trade remains a popular narrative due to increased money printing and geopolitical shifts, the precious metals are non yielding assets. In a year defined by falling interest rates, aggressive quantitative easing, the opportunity cost of holding gold or silver is exceptionally high. Investors would essentially be passing up the 8 to 12% average return or 15 to 30% as we've seen since about 2020 and compounding dividends on top of that of the S&P 500 for a metal that simply sits in a vault hoping for a fear-based price spike that may never happen. Furthermore, the 2026 market is heavily tilted toward productivity and innovation, two areas where metals simply cannot compete. The S&P 500 is increasingly concentrated in AI-driven tech giants that are successfully expanding profit margins through automation and software scaling. This growth exceptionalism creates a magnetic pull for global capital. As long as the Federal Reserve successfully manages a soft landing and corporate earnings remain robust, the incentive to move into safe haven assets like gold is diminished. Even silver, despite its industrial utility in solar and EV sectors, remains a high beta play that often suffers from the same speculative volatility that can trap retail investors during market rotations. Lastly, the technical setup for 2026 suggests a consolidation phase after a record breaking rally in 2025. Many analysts, including those from JP Morgan, anticipate that gold and silver will trade sideways or digest, if you will, their previous gains as the market rebalances. When you factor in the additional costs of physical storage, insurance, and the wide spreads found in retail metal markets, the real return for an individual investor becomes even less attractive. Consequently, while precious metals offer necessary diversification to prevent a portfolio from reaching an F tier, if you will, since we're on that topic, they lack the compounding power and industrial momentum required to be an S tier or A tier leader in a liquid tech dominant 2026 stock market. So, for those reasons, I know some of you might not like to hear this, but this is going in the C tier for me. That's all for today. Thanks for watching, guys. If you stayed this long, please consider subscribing and turning on the post notifications so you know when I upload. I'd really appreciate that. And since I clearly don't have an upload schedule since this is my second video, yeah, you'll know when I upload. And also, if you love some of the stuff I said or hate it, let me hear it. Let me hear it in the comments. And if you got some video ideas or topics you want me to talk about, leave that down there too. I might talk about your idea. So that's all I got. I'll probably see you guys in next upload, which I plan on doing sometime early next week. All right. See you guys.